In this lesson, I want to discuss what is Bitcoin. Bitcoin is a decentralized digital currency that operates on a peer-to-peer network. It was created in 2009 by an unknown person or group using the pseudonym Satoshi Nakamoto. Bitcoin is the first and most well-known cryptocurrency, and it has been the inspiration for many other cryptocurrencies that have been created since. Unlike traditional currencies, Bitcoin operates independently of a central bank or government. Transactions are recorded on a decentralized public ledger known as the blockchain, which ensures that transactions are secure, transparent, and immutable. The supply of Bitcoin is limited to 21 million coins, which helps to prevent inflation and ensure stability in its value. Bitcoins can be bought and sold on a variety of online exchanges, and they can also be used to purchase goods and services from merchants who accept them. The value of Bitcoin is determined by market supply and demand, and it has experienced significant fluctuations in its price over time. Despite its popularity and growing adoption, Bitcoin is still considered a risky investment by some, and it is not widely accepted as a form of payment by mainstream merchants. However, as blockchain technology continues to gain traction, many experts predict that the use and adoption of cryptocurrencies, including Bitcoin, will continue to grow in the coming years. So how does Bitcoin work? Well, Bitcoin operates on a decentralized network, allowing for peer-to-peer transactions without the need for intermediaries such as banks. This is made possible by the use of blockchain technology. Here's a brief overview of how it works. So we have transactions. So when a user wants to send bitcoins to another user, they initiate a transaction. The transaction includes the addresses of the sender and the recipient, the amount of bitcoins being sent, and a digital signature to verify the authenticity of the transaction. Then we have verification. So the transaction is broadcast to the network and verified by nodes, which are computers that run the Bitcoin software. The nodes check that the sender has enough bitcoins to complete the transaction and that the transaction follows the rules of the Bitcoin protocol. Then we have block creation. So once the transaction has been verified, it is added to a block along with other verified transactions. The block is then cryptographically linked to the previous block in the blockchain, creating a permanent and secure record of all transactions. Now, the process of verifying transactions and adding them to the blockchain is known as mining. Miners are nodes that compete to solve complex mathematical problems in order to validate transactions and add them to the blockchain. As a reward for their work, miners receive newly minted bitcoins and transaction fees. After the block has been added to the blockchain, the transactions within the block are considered confirmed. The more blocks that are added after a particular block, the more secure and irreversible the transactions within the block become. So we have briefly covered this, but what is Bitcoin mining? Bitcoin mining is the process of verifying transactions on the Bitcoin network and adding them to the blockchain. Miners are nodes on the network that perform this work and are incentivized with newly minted bitcoins and transaction fees for their efforts. The process of mining involves solving complex mathematical problems to validate transactions and create new blocks. Each block contains a list of verified transactions, and once a block is added to the blockchain, the transactions within the block are considered confirmed. In order to mine bitcoins, a miner must have specialized mining hardware and software. The hardware is used to perform the complex mathematical calculations required to validate transactions, while the software is used to manage the mining process and communicate with the rest of the network. Bitcoin mining serves two important purposes. It confirms transactions and ensures the security of the blockchain. By verifying transactions, miners help to prevent fraud and double spending, while by adding blocks to the blockchain, they help to secure the network and maintain its integrity.